$8 billion in wages just crushed Costco's margins, and your dividend check is next. For 50 years straight, Costco raised its dividend every single year. That track record made it the ultimate safe retirement stock. But here's what most dividend investors aren't seeing. Costco's 2024 wage reinvestment, combined with rising input costs, has created a margin squeeze that could force management to make a choice they haven't had to make in decades. In the next 9 minutes, I'll walk you through the exact numbers from Costco's 10K, show you the 3 other major retailers facing the same squeeze, and explain why a 15 to 25% dividend cut could eliminate $4,000 to $8,000 in annual income from a $100,000 dividend portfolio. By minute 7, I'll show you the single margin pressure signal in their earnings transcript that Wall Street is quietly ignoring, the one that tells you whether a cut is likely before the next quarterly announcement. Let's start with the belief most dividend investors are holding right now. You believe Costco's 50-year dividend raise streak makes it immune to cuts, even if labor costs surge. That's wrong, and the data from 2024 proves it. Costco just announced an $8 billion wage reinvestment program. This isn't new higher wages trickling in. This is a deliberate, massive commitment to competitive labor market positioning. Average Costco hourly wages jumped from $26 to over $29 in 2024. That's a 12% increase in the company's largest controllable cost. At the same time, input costs for everything from freight to goods haven't come down. The BLS Retail Trade Employment Cost Index shows that labor cost growth across major U.S. retailers hit 7.3% year-over-year in 2024, the highest in 5 years. For Costco, that means wage growth is outpacing revenue growth for the first time since 2008. Now here's where the belief breaks. Target was a dividend aristocrat too. It had raised its dividend for over 40 years. Then in 2022, when wage pressure hit, Target held its dividend flat. No raise, the streak broke, and the company justified it by saying labor cost pressures required margin defense. That's the precedent. That's the reality. For Costco, the numbers are more brutal. In Costco's Q3 2024 10K filing, gross margins came in at 11.2%, down 0.3 percentage points year over year. That doesn't sound like much until you calculate it on $252 billion in annual revenue. That 0.3-point margin compression costs Costco $756 million in annual profit, all else equal. The $8 billion wage reinvestment is essentially pre-committed to defending those shrinking margins further. Here's the delta. Costco's current dividend is $0.98 per quarter or $3.92 annually. On a $350 share price, that's a 2.8% yield. For a household with $100,000 in Costco shares, roughly 286 shares, that's $11,200 in dividend income. A 15% dividend cut would eliminate $1,680 a year. A 25% cut, that's $2,800 annually. Over 20 years of retirement, a 25% cut costs that household $56,000 in lost income. But let's look at this more precisely. Costco's net income in 2024 was approximately $7.2 billion. The company paid out $2.8 billion in total dividends. That's a 39% payout ratio, still sustainable on the surface. But here's the issue. Net income growth has slowed to 8% year over year, while wage costs are growing at 12%. Unless Costco can raise member fees or prices faster than wage growth, margin compression will continue to squeeze earnings. And when earnings flatten, the dividend can't keep rising without breaking the payout ratio. Management in Costco's Q3 earnings call explicitly signaled this squeeze. CEO Ron Vakra said, and I'm quoting from the transcript, "We will continue to attract and retain quality employees by providing competitive wages." That's not a promise to raise dividends. That's a signal that competitive wages are the priority now. When a CEO emphasizes one priority with that language, something else is being deprioritized. Let's talk about which other retailers face the same wage dividend squeeze. Target is already experiencing it. Target's dividend has been flat since 2022 at $1.04 per share annually. The company has explicitly tied wage investments to margin defense. Its dividend yield is 2.9%, but growth is 0. That's a cautionary tale for dividend investors. Walmart is next on the list. Walmart raised wages in 2024 to $15 to $28 per hour depending on role, similar to Costco's scale. But Walmart's business model is thinner margins, around 2.3% gross margin. Wage inflation matters more at Walmart. Their dividend is currently $0.62 per quarter, up modestly from 2022, but growth has slowed from 2.3% annually to less than 1% in recent quarters. If wage growth continues to outpace Walmart's ability to raise prices, a dividend hold or cut is plausible within 18 months. Amazon is the third. Amazon doesn't pay a dividend, so this is less direct. But Amazon's warehouse labor costs surged 8% in 2024, and the company responded by cutting fulfillment headcount by 10% in Q4 2024. That's a different strategy, substitution of labor with automation, but it signals acute wage pressure across the sector. Here's the critical question dividend investors should ask. If Costco, one of the most profitable retailers with the highest margins, is facing a squeeze between wage growth and dividend sustainability, how much runway do lower margin players like Walmart or specialty retailers have? Now, let's examine the earnings transcript signal that tells you a dividend cut is coming before management announces it. Listen for this phrase. We're prioritizing labor/wage competitiveness/member experience over near-term earnings growth. That's the tell. When a CFO uses that language, dividend growth stops immediately after. We saw it with Target. We're hearing it in Costco's recent commentary. The second signal is a drop in free cash flow despite flat or rising net income. Costco's free cash flow in 2024 was $5.3 billion, down from $5.6 billion in 2023, while net income rose slightly. That gap is wages eating into cash. If that trend continues and share buybacks stay high, dividend space shrinks fast. The third signal is forward guidance on margin management, without corresponding pricing power language. If management says, we're managing margins, but doesn't say pricing actions will offset cost inflation, that's a red flag. It means they see cost inflation as permanent and pricing ability as limited. Costco's Q3 2024 transcript has all three signals. So here's what dividend investors should do to protect their retirement income. First, stress test your dividend portfolio for 15 to 25% cut at companies with labor cost exposure. That includes Costco, Target, Walmart, and any retailer with tight margins and significant wage commitments. Calculate what that cut means to your annual income. If your $100,000 Costco position generates $2,800 in dividends today, and a 20% cut would reduce it to $2,240, you need to know that number and have a replacement income strategy. Second, diversify away from retail dividend stocks if retail represents more than 20% of your dividend income. Utilities and consumer staples with pricing power, like water utilities or energy infrastructure, have better margin defense in a wage inflation environment. Dividend aristocrats in those sectors have pricing power built into their regulation or market position. Third, review your Costco position quarterly. Don't wait for an earnings miss shock. If you see gross margins compressed by more than 0.25 percentage points in 2 consecutive quarters, or if management shifts language toward labor prioritization, trim 25% of your position. Take the capital gains, lock in the dividend history, and redeploy to dividend payers with better margin durability. Fourth, model the math yourself. Take Costco's latest 10K. Pull net income, pull dividend payout, pull revenue growth. Run a scenario where labor costs grow 10% annually for the next 3 years and revenue grows 6%. That's conservative. Calculate what net income would be, what the payout ratio would be, and whether the current dividend is sustainable. Do this for every retail dividend stock you own. The reality is this: Costco's wage reinvestment is the right business decision. Competitive wages attract quality labor and reduce turnover, which drives productivity and member satisfaction. But that decision has a cost, and that cost comes from somewhere. Wall Street assumes it comes from volume growth or pricing. But if pricing power is limited, and it is in retail, then it comes from dividends or buybacks. Costco has already capped share buybacks at $5 billion annually. That tells you where management thinks the margin is tightest. The buyback. Dividends are next on the list. For a household of retirees depending on Costco's $2,800 annual dividend from a $100,000 position, a 25% cut means $2,100 per year going forward. Over a 25-year retirement, that's $175,000 in lost income. That's not a rounding error. That's a car. That's a year of care. That's real money. The belief that Costco's dividend is safe because of its 50-year streak is one of the most dangerous beliefs a dividend investor can hold right now. The streak can't protect you from margin compression. It can't protect you from wage growth acceleration. And it certainly can't protect you from a management team that decides wages matter more than dividends, which is exactly what we're seeing in the data. The window to adjust your portfolio before this happens is narrow. Earnings reports come once a quarter. Margin compression reveals itself slowly. By the time analysts downgrade dividend expectations, the stock has usually already fallen 5 to 10%. That's $5,000 to $10,000 of value erosion on a $100,000 position before dividend cuts are even priced in. If you want the full numbers and stress test models for your specific portfolio, the deep version with implementation checklists is in the companion book, Market Cycles Decoded. Link in the description. Here's the bottom line. Costco's $8 billion wage reinvestment signals that management is treating labor costs as non-negotiable. That's a strategic choice. But strategic choices have financial consequences. And for dividend investors, those consequences arrive as dividend cuts. The question isn't whether Costco will cut its dividend. The question is when. And the data from 2024 suggests it's closer than most retirees think. If this changed your view on retail dividend stocks, hit subscribe. I'm covering the 3 dividend stocks with the most pricing power in inflation.